Hi everyone, welcome to Wine and Real Estate.
Bonjour tout le monde. Thanks for joining us today.
So tonight we have something different and fun that we want to do. Of course we want to talk about wine. So it's a tongue twister, it's a Gewütraminer.
Yes, I can never say that. Gewütraminer.
Anyway.
Anyway, what is interesting, we actually went to Prince Edward County and picked the grapes for
Gewütraminer.
What was the name of the
vineyard? So we went to by Chad C's Cairns. It's a beautiful vineyard, and they had those grapes. It's actually a pink grape, and it produces a white wine. So very nice, light white wine, and it's kind of fruity. I can actually.
Yeah, it kind of had like those peach undertones, and anyway, it was very, very good. I don't usually like red wine. It usually gives white wine. Sorry, it gives me headaches. But this one didn't give me a headache because it's actually, like François said, made out of he said pink grapes, but they're kind of purple.
Yeah, reddish purple.
Anyway,
very unusual color.
They're not green grapes. They're purpley pink grapes. So anyway, very good wine, and this one's actually Jackson Triggs from Niagara. So this one is also a very good one. We didn't actually get to taste the wine from the grapes that we picked, but we bought this one, and it was very good.
Yeah, we wish we could have bought it, but with COVID and everything, it's a bit complicated. So
yes.
And then the second thing we want to talk about real estate lingo. So real estate investment
lingo.
Yeah.
Just for people that are new or maybe are not clear, there's certainly people who follow us that don't do real estate investments. That's one of them, REI, real estate investing. So it could be just a learning thing that maybe you'll learn a few words that as we go along tonight.
Yeah, we just wanted to go over some definitions. Some of them we've heard it as well. We weren't too sure. NOI. At first, I kept hearing about NOI. So what does that mean? The noi? I'm annoyed.
So it's a net operating income. So basically, it's what's left over after you pay your expenses. So your revenue, so usually rent, coin-op, laundry, parking, whatever you have as a revenue on your real estate investment, less whatever your costs are. So mortgage, taxes, all the fun stuff that it costs. And then what's left over is your NOI, your net operating income.
And it's an important number, mostly in commercial lending. So something that you actually can borrow on your NOI. So,
and it usually is limited to a certain percentage of your NOI when you're looking at units that are more than 5 apartments. So
yes.
And then there is also current market value, so CMV. I'm doing this backwards. CMV, current market value.
Yeah, I'm like, okay, what's the abbreviation there?
Sorry, it's a Tuesday night. So this could be the value for which you sell your property or your building today. What would it be worth today? So obviously in Ottawa and in Canada's crazy markets right now, this can vary
greatly. It could be this, could be this much. It doesn't fit in the screen.
I don't think it would be this. It would just mostly be this, and this.
And beyond.
But I think that it kind of gives you a good starting place for even refinancing. So a refi, that's another thing that people say a lot, refi. Yeah,
what's a refi? So refinancing, it's part of the BRRRR strategy, which is not on the list here, but what's a BRRRR? Yes, it is getting cold outside, but that's not that kind of BRRRR. So do you know what is the BRRRR strategy?
Oh my goodness, I always forget all of the R's because there's like 3 or 4 of them. So it's buy, renovate, rent, refinance, and repeat.
Exactly. So why would you want to do that?
Well, basically you want to buy a property that needs a little bit of work, renovate it, rent it out for good market rent, and then you refinance. So you're getting the money that you put into the renovations and the work out of the property, so that way you can redo it again, which is the repeat part.
Exactly. So this helps with your cash flow, which is another word we want to talk about.
Yeah.
So I kind of skipped one there, but cash flow is very important. So with the BRRRR, you might be receiving some monthly cash flow, maybe not. That's something you need to consider before you refinance. Because when you refinance, yes, you do get a big chunk of money back, but as well, your cash flow might be affected because your mortgage, let's
go
say,
up a little bit.
Yeah, well, usually quite a bit. Usually,
it depends on how much you're going to be able to refi for.
So the goal, like in the BRRRR, normally is to get back everything you've put in. So if you put in 100,000, like renovation, everything, you want to pull all of that out, ideally, anyway. So.
Yeah, that would be the ideal BRRRR because you're going to be using that money and then putting it on another property and then doing that continuously. So we're looking forward to seeing what 2021 is going to look like for the BRRRR strategy because we're not sure what the banks are going to be doing with the economy and everything. So we'll see what.
Yeah, but I heard some good news. 2 or 3 weeks ago, Scotiabank started allowing people to use their HELOC, so their home equity line of credit,
which
as a deposit.
Doing anymore.
Yeah, they had stopped at the beginning of COVID, and now they went back to it. So I guess they're seeing that investors are being careful and cautious with their money and not over leveraging themselves. So leveraging, that's another word I didn't put on the list there. So what is leveraging, Jennifer? I'm testing you tonight.
I feel like I'm back in school.
Yes.
Well, leveraging is basically using, it could be your money, other people's money to buy and invest in real estate. If you're over leveraging, that means that you're using too much of your own money or getting into too much debt, basically, to invest in real estate.
Exactly. So this gets into also the cap rate. So what is the cap rate? Again, that's more a commercial term. So when you get into larger multifamilies, that's when you want the cap rate and the NOI. The cap rate is the NOI divided by current market value of the asset.
Yeah, so those are the two that we mentioned. NOI divided by CMV will give you the cap rate, and that gives you an idea of how much the property is worth, how much you can borrow
to buy
property.
it.
Some banks won't look at anything that's below a 7% cap rate, for example, or 8%. It doesn't matter the percentage, but that's something that you have to speak with your bank or mortgage broker about so that you know where the property sits for financing. Yeah,
because they're going to ask you, are you getting an 8 cap? Are you looking at a 7 cap? So you have to know if you're purchasing a property and it's a 10 cap, then maybe it's way too much for the market. Like Ottawa is way lower, the cap rate, because the values are so high. But if you go with underperforming properties in smaller markets, then the cap rate is usually higher and then the risk is higher. Mm-hmm. So like we prefer secondary markets and the cap rates tend to be higher there.
Yes. Well, because the property is worth less, but the rent could still be pretty decent compared to if you're buying in a bigger city like in Ottawa. You're not going to be even close to the 1% rule, which is another thing that people say a lot, the 1% rule. So that's the rent, which it would be nice if it's at least 1% of the price that you're paying for the property, which means if your rent from the property is $4,000 a month, then the 1% rule would be that the property, you would buy it for $400,000. That doesn't work in very, very many markets.
That would be lovely here.
It would be nice, but it is often possible in secondary markets. So that's why we often look at secondary markets. Yeah,
because like here, let's say we bought a duplex at $800,000. Good luck renting that for $8,000 a month. I mean,
that'd be $4,000
per unit. Yeah,
that would be a lot.
It's a little rich. We'd have to go very high end, and then we would not pay $800,000. We'd pay like $1.5 million. So that's a whole different story.
We have seen some duplexes at $1.5 million in Ottawa. So
yeah, we're not getting $15,000 in rent for that.
No.
But you can get creative. I mean, you can look at efficiencies, so charging for parking, including internet and then increasing their rent, including housekeeping. That's a fun one I heard. So people include it in the rent and then they charge a much higher rent. You just have to be creative, but I don't think you could stretch it that high.
No, probably not. So another thing that we often talk about in real estate investing is cash on cash return. So that's something that actually I learned recently. So cash on cash return is your annual pre-tax cash flow divided by the total cash that you have invested in the property. So a lot of money partners or people that are investing in real estate want to know or have an idea of what the cash on cash return is, which isn't necessarily all of the return or all of the ROI, which is return on investment, but I think it gives a good idea if the investment is solid or not.
Yeah, exactly. And that's not a figure we were using much, but I think we will start including it as we look at larger properties, as we get into more borrowing from private lenders and eventually becoming lenders ourselves. So yeah, we'll want to know what the cash on cash return is. What's CMA? So comparative market analysis. That's something your
real estate agent
can provide you with. It's often requested by banks. They want to know, especially during a refi, they want to know, okay, we want to see comparatives. What is the market saying? How much is your property worth? Of course, you'll need an appraiser, but they'll also want a CMA.
So CMA will just basically be an analysis of other properties that are similar to yours that have sold in the area. So they can't always compare apples to apples, but they could even compare sometimes apples to oranges and then kind of do balance it out. So they'll say, okay, yours has this one doesn't have that. So they'll kind of get an idea of what they're comparing with and kind of get closer to the apples to apples scenario.
Yeah, gauge it. Kind of like we're doing right now. So we're looking at we own a duplex on one street, and there's a duplex just a few houses down. But the lot is bigger, but the building itself is smaller. So we're like, okay, well, it's worth a bit less because the building's smaller, but the lot is bigger. So it offers different opportunities. So we have to do our own CMA.
Yes, I can't wait to see what it sells for.
Yeah, that's something else. So if you have a good realtor on your team, sometimes you're able to ask, okay, how much did this place go for? And that way you have a good gauge on what's going on in the market. VTB, so vendor take back. That's another really important term for investors. So what is a VTB, Jennifer?
Oh my gosh, I think François doesn't want to answer any of the questions.
No.
So a VTB is when the owner, or sometimes they call it owner financing or seller financing. So the actual owner of the building holds the second mortgage or portion of the sale for you and charges you interest. So instead of having the down payment yourself, you can negotiate, not always, but you can negotiate a VTB or a vendor take back.
And what's the benefit of this for the vendor, the owner? Yeah.
Wow, for the real estate investor, it's great because you don't have to come up. You don't have to cough up the cash.
Yes.
But for the owner, it can be good as well. First of all, they're going to get a little bit more money because they're going to be making interest off of that money. And secondly, they're also going to be deferring the capital gains on the sale of their property because they won't be getting all the big chunk right away. So the capital gains will be kind of put over a period of time. So it could be 2 years, 3 years, 5 years. So a VTB will make it that the owner isn't getting as much capital gains all in one shot.
Exactly. LTV, so loan to value, that's a big one as well. So we're talking about real estate lingo right now. LTV, loan to value. So what can you say about that?
Also didn't have any wine tonight, so
no, I know the bottle's actually empty.
I want to get some more. That I can't say the word, but it's very good. I've never had white wine that I liked before. But anyway, LTV, loan to value. So that's very important when you're looking at real estate investing because you want to be able to have. Ideally, you can get 80% loan to value, but
85 if it's the MHC, 95 if it's your first house, or you can find someone to qualify for you.
But oftentimes when you start getting more properties, the loan to values that the banks will let you have will get lower and lower. So it could go to 75 and then 70 and then 65.
60 commercial, so, 65,
yeah. And
70.
then with the more units you have in the property itself could also change the loan to value that the bank will allow you to have.
Yes. Next term is ARV, so after repaired value. So that kind of ties in with the BRRRR strategy. So you need to know your ARV. Well, you need to plan it in advance. You buy it for a certain amount. How much is it going to be worth once you're done renovating and when the time comes to refinance? And of course, you need to plan carefully, because I find appraisers tend to not lowball, but if there's two prices, they're going to be taking the lower of the two prices.
They could be more conservative.
Yeah, which is good. I mean, you don't want to over leverage, which is something we mentioned earlier. So
yes,
leveraging, yeah.
But the ARV, which is the after repaired value, is really important for your refinancing, and it depends on what the other. It kind of goes with the CMA, which is the comparative market analysis, which where am I going with this?
I'm not sure.
Okay, which is basically what is the house worth once it's all repaired and renovated. So they'll compare it with houses that are already repaired and valued. That's why I was going with that.
There you go. You need some wine too. Yes. We need some Gewütraminer.
It's been a long day. But yeah, that's where I was going with that. That they're going to be comparing your property repaired and renovated with other properties that are already repaired and renovated for your refi.
Yeah, which is something else that's important. So people buy properties and then they buy this cute little place. It's very unique, and then there's no comparables. Good luck refinancing that property. You need comparables, so they're very much reliant on that. It's like buying a house on a street and all the houses have big garages and 2 stories, and then this one's a bungalow with a carport. It's not going to command as much money as it should, so you have to be careful when you buy. You buy the right place at the right price.
Yeah, that's very important.
DTI, debt to income ratio. So that's a good one.
Yes. So for your first few properties, since François making me explain all of the lingo.
But you're smart. So.
So the debt to income ratio is very important for your first property, and when you're doing properties that are 4 units and less, because your income and your debt are going to be looked at strongly by the bank. So you want to make sure that your debt to income ratio is, I think it's lower than 40%?
44. Depends on the bank. Like Scotia goes up to 44, and then you fall into a B lender. So non-traditional banks or credit unions.
Not the big 5.
Yeah.
So that's an important thing for your first few, or like we said, when you're doing investments for smaller units.
And then something important with the debt to income ratio, an easy tip we did just last week or this week. When did we pick up the car? Yeah, so we got a new car for a lower price than we paid the other car, and actually that reduced our debt to income ratio. So our payment is $100 less, which equals quite a bit more borrowing power.
Yeah. Exactly.
Not like mountains, but $100 does make a difference. I was talking to our mortgage broker, and we were looking at a property, and I think we were $900 short. So I mean, if you have $100 off your car payment, and then you start adding things, depending on what you're trying to buy, then maybe there's efficiencies you can find, and then 1 month later, maybe you qualify for that extra property or extra loan, or the refinancing. So it's very interesting.
Because some good mortgage brokers that are working with investors can get you up to 8 to 10 mortgages for the smaller properties, and then afterwards, you're going into the commercial side of things. So
I've heard actually even up to 20. So
really? Wow.
If you're very savvy and you don't, like us, we're always both on
and
title.
You don't drink wine.
They don't drink too much wine. So yeah, I've heard if you don't both go on title, so if each person, like I went on title alone and qualified, and then Jennifer went alone, then you could get sort of 10 each or more.
Okay.
So it depends on where you're buying.
That would be a lot to manage, so don't...
I know, and the person that mentioned that, they were buying properties that were a lot less expensive, so in the 100 to 200,000 range, while we're looking more at 500-600K, so that makes a big difference. So we have one last term.
Yes, and I'm going to make you tell us the definition.
No.
So it's DCR, or debt coverage ratio.
Yes, so what does that mean? So that's a term when it's kind of used, well, it's used in underwriting. So when someone is trying to borrow, especially for a commercial building, then they want to see the debt coverage ratio. So how much income will the building bring in, the NOI, net operating income, versus all the expenses, but related to the debt. So the mortgage versus the income, so the rents coming in.
Yes, so some banks or lenders will let you have up to 1.2 debt coverage ratio, and then some of them, they go higher, so it has to be 1.3 or 1.4 or 1.5. So that would be something you have to find out with your bank to see what kind of properties you can analyze and make sure that they have a good debt coverage ratio.
DCR. So yeah, I'm hearing more and more 1.25, 1.3 and up.
Yes. Yeah,
more
banks are
and more.
getting more conservative, but...
They want to see more cash, so that's where you have to be creative. That cash can come from somewhere.
Yes. So anyway, if this all sounds like Chinese to you, maybe you need to work with seasoned real estate investors that can help you build your portfolio.
Exactly. So that's why we do some joint ventures. We partner with people. We partner with private lenders. So yeah, we want to help people, and make sure to check out the right club. So www.reitegclub.com, and you can ask some questions there. You can ask us some questions as well. We love chatting with people and helping you grow.
And I think that Jared wrote there.
Yes, he said talk soon, guys.
Oh, okay.
So,
yes.
It was nice. Another nice investor who's been on multiple podcasts. So we love sharing with other investors, new and seasoned investors, and just helping you grow. Like the Right Club says, come and grow with us. Well, we agree, come and grow with us. Because when you grow, we grow as well. We learn from everybody. So.
Yeah, it's really a great experience working with other people.
So until next time, that's it for Wine Real Estate Tonight. Next week, we have a great guest, Cam Rowland from The Creative Investor. So I'm excited to hear what he's
tell us a little bit about what Cam does so that we can wet their whistle.
That's a good question. I'm just kidding. So he does lease, I think it's lease options, which is rent to own. We call it more rent to own. But he's got an interesting technique. So he's looking for frustrated and tired landlords, and to get some deals that are off market or at a better price. And I'm sure he's working in some vendor take-backs and different things. So can't wait to find out.
Yeah, I can't wait to hear about that for sure.
Yeah, something new to try. So next time, that's it. So we'll be talking about that. It's next Tuesday, 7 p.m. live on Instagram.
And we should also mention what's happening tomorrow.
Yeah, tomorrow night, an exciting event with the Right Club. So it's an Ottawa-focused session at 7 p.m. You can still register for free. It's going to be webinar style, and then there's about an hour. We have some great guest speakers, and then we have Rasna Aurora from Ottawa, Just Right Rentals. So she's bought a lot of properties and is very successful in Ottawa in this crazy market. And we have some networking at the end. We're going to have market updates, different things. So we hope to see you there as well.
Yeah, that'll be exciting.
Yes. So
until next time, chin chin.
Chin chin, salud, and we'll have some wine next time. So next time we can't drink it in advance. We have to. But we wanted to sample it for you guys. We care about you, so we have to drink it. So. Too bad. So next time I'm not sure what we'll get, but some sort of an interesting
It'll be
wine.
a surprise.
Yes. Have a good evening.
Thank you. Bye-bye.
Bye.